Hi friends, today we are going to discuss about cash flow statements. Till now we have studied about various accounting standards. Before going through accounting standard 3, let us know about cash flow statement. What is the meaning of cash flow statement? So it is also one of the important topic in IPCC level. From accounts point of view also it is important, and from financial management also it is important. So it may get for 8 marks in accounts or financial management. So let us study briefly about cash flow statement. Here cash refers to cash or bank or cash equivalent. Cash equivalent means which is ready realizable in cash within a short period. And what is the flow? Here flow refers to inflow or outflow of cash, and the statement here refers to explanation for the changes in cash and bank balance. So we can call, in simple, we can call CFS refers to statement of changes in cash and cash equivalent, and also it is prepared for a period that is April to March. Being a period statement, we consider opening cash and cash equivalent, and also by way in April to March there is a many inflow and outflow of cash. So after all these transactions at April March, we can arrive at closing balances. So this is the simple meaning of cash flow statement. Now let us see what is the format of cash flow statement. And in that format we have many operating activities, financial activities and investment activities. Let us see in a format. Okay friends, now we are going to see about format of CFS. So here CFS for a period of 1st April 2015 to 31st March 2016. Now what is the format here means? Cash flow from operating activities we should take, and some amount we will arrive. After that we should add plus or minus, if plus balance we should add for that cash flow from financing activities, and later there is one more, that is cash flow from investing activities. After that, if we have a positive balances, we should add. So this is the cash movement during the year. After, you should add opening cash and cash equivalent to cash movement during the year. So you will get closing cash and cash equivalent during the year. So this is the format of CFS. Next, one question here arises. Already we have seen what is cash flow statement and what is the format of cash flow statement. Now what is the question means? Who is under obligation to prepare CFS? The answer is all level 1 enterprises are under obligation to prepare CFS. Such level 1 enterprises, here again question arises. Who is the level 1 enterprises? Again the answer is any company which is listed or in the process of listing, any entity having turnover of 50 crores or more in the immediate previous year, and any entity having borrowing of greater than 10 crores, and any company being a banking company or public financial institutions, and the last entity who is subsidiary on holding of another company being level 1 enterprises. So these are the level 1 enterprises who is under obligation to prepare CFS as per AS3. Note here, as per clause 49 of the listing agreements, all listed companies should prepare CFS. In case CFS is prepared, it has to be as per the norms of AS3, that is issued by the ICAI. As an auditor, when he expresses his opinion in the financial statement, he is expressing opinion even on CFS, as CFS is an annex of financial statements. Financial statements are incomplete without CFS. So till now we know the financial statements means trading account, P&L account and balance sheet. So while learning about CFS, we need to know that is financial statement is incomplete without CFS. So financial statement includes CFS also. Now next, what are the needs of preparation of CFS? Here, due to the statutory regulations and understanding the solvency of entity, and to understand from where the cash equivalent is, or cash is generated. So to understand these, we need to prepare CFS. And next term, understanding the cash equivalents. If the following conditions are satisfied, we can say that investment is a cash equivalent. So when you are going to invest, how you can say that is a cash equivalent? It means there should be an investment. Generally, it is held for short-term purpose, less than 6 months, and easily marketable. So what is the conditions means? It should be investment, and next it should be a investment, but it should be a short term. It is a short period. It is maybe less than 6 months, and it is should be easily marketable. It is easily marketable means whenever you want to sell this investment, so it is easily marketable. It should be easily marketable in the market. So it is readily realizable in known amount, and these investments are subject to the insignificant risk. It means very less risk. So what do you understand by cash equivalent? Cash equivalent means there should be investment, and the investment should be a short period or short term, that is a less than 6 months, and it should be easily marketable, and you should know what the amount is going to realize, and it should be a very less risk. And what are the examples of cash equivalent? Let us see some examples. That is short term FDs or commercial papers, treasury bills, secured debentures, or any other instruments. These are the example for cash equivalent. So now you got an idea about cash equivalent. A investment in cash equivalent will not form part of investing activities. Investment in cash equivalent will be presented as a part of computation while preparing CFS. So as investing activity, we can say that if a short term investment, it goes to the investing activities. No, it is wrong. As it is a short term investment, that is less than 6 months, it is go under the head of cash equivalent, and it is used while preparing CFS at the first, that is opening cash and equivalent. At the stage we will use. And how to compute cash and cash equivalent? So till now we have studied that cash, bank balance, and cash equivalent. So how you will compute cash equivalent? Let us see. So friends, this is the format how to compute cash equivalent. Here, what is the first? That is, we can look at the question, that is opening cash balance and opening bank balance and opening cash equivalent. After that, you adding these, you will arrive an amount. From that, you should deduct opening OD balance, that is overdraft balance, and after that you should also deduct cash equivalent. So we have put their minus, and we will arrive opening cash and cash equivalent. So how you will prepare closing cash and cash equivalent? The process is same. How you prepare opening cash and cash equivalent is the same manner and same process for the closing to prepare closing cash and cash equivalent. After that, we have said the while seeing the format, what is we should know what is the operating activities, what is the investing activities, and what is the financing activities. Let us look clearly what is the operating activities. Friends, we have seen the format of CFS. Now in that, first we have, that is operating activities. So what is the operating activities? Here operating activities means an activity which is principal revenue generating activity, that is which is activity in relation to core business. So that is known as operating activity. Now all those which are not investing and financial activities also come under the head of operating activities. And an operating activity may differ from entity to entity, because some entities have operating activities, some, that is for an entity which is in the business of purchasing land and building, it is an operating activity. For the another is may it consider as a investing activity. Some of the examples for operating activities are purchasing of goods, sale of goods for cash and receipt from debtors, payment of salaries and payment of operating expenses, discount of bill receivable. So these are the some of the examples for operating activities. Now let us know what is financial activities. Here financial activities are those activities which are results in the change in the composition of capital. That is, in balance sheet, whatever changes arise for a liability side, that is share capital, debentures or long term borrowings. So what are the changes occurring from the liability side of a long term capitals or long term liabilities? Those are comes under the head of financial activities. The examples are share capital, debentures, long term borrowings and preferential share capital. So these are the examples for financial activities. Let us see some examples, that is rising of equity share capital, or rising of preferential share capital, and rising of debenture capital. So there occur a change in the liability side, so this comes to the financial activities. Likewise, when you redeem or buyback of equity shares capital or buyback of preference share capital, there is a decrease in the share capital. So these are the changes which are held in liability side, comes under the financial activities. Now we are going to discuss about investment activities. These investment activities are those activities which are in relation to acquisition or disposal of long-term assets or investments. Some of the examples for investing activities are purchasing of fixed assets or long-term investments for cash, sale of fixed assets or long-term investment for cash. So these are the some of the examples for investing activities. So this is the meaning of operating activities, financial activities and investing activities. So friends, we have already seen what is operating activities. Now these operating activities are divided into two methods, that is direct method and indirect method. In direct method, we consider all cash inflows and all cash outflows, and we will arrive at cash flows from operating activities. Now let us see cash received from sales or cash sales, and cash received from debtors, trade commission received in cash, and what is we should deduct, that is cash purchases, payment to creditors and payment of salaries, payment of operating expenses. So we will arrive cash flow from operating activities before tax. After that you should pay tax, that is we have deducted from it. So after that you will arrive cash flow from operating activities after tax. Now we should add or deduct cash flow generated for extraordinary items. Now we will arrive cash flow from operating activities. So this is the direct method for the computation of operating activities under CFS. Indirect method. In indirect method, we should take profit as per P&L account, that is profit from the profit and loss account. After that you should do some add adjustments and less adjustments. What are those means? Now what is the actual cash outflow you should deduct. For example, depreciation is not an actual outflow, just we have created a depreciation amount in P&L account. So because of this our profit is going to decrease. To avoid this, we are adding back to the profit. So depreciation amount we are adding back to the profit. So we will arrive original cash inflow or outflow from our entity. It is an financing activity. We should go through financing activity, but it is come under the head of operating activity. So we should add back to the profit. And when we come to the provision for tax, it provision is not a loss, because just we are estimating and keeping a for the payment of tax. So it is also not present outflow, but we are deducting from the P&L account, that is we have shown the expenditure, so our profit is reduced. So now also you add to the profit. Now you will get what is the actual cash outflow. Likewise, when we sell on investment or if sale of fixed assets, whatever loss you getting, you are debiting to the P&L account. So then your profit is going to decrease. So to avoid because as it is a investment and fixed assets, it deals with the investing activities, does not deals with the operating activities. So you should add back to the profit, so your profit will be increased. Likewise, we have some less adjustments also, that is likewise loss on sale of fixed assets or investments, however we added to that. Likewise, profit also we should deduct from P&L, that is profit from P&L account, because when you are making a profit on sale of fixed assets or investments, it is an investing activities. It should be reflected in the investing activities, not from the operating activities. Because of that reason, we are going to decrease our profit on sale of fixed asset, because it is an investing activity. Likewise, and when there is an income tax refund also, you should deduct from it. So these are the less adjustments, and while doing problems you will get know more what are the add adjustments and less adjustments. After that you will arrive at operating cash flow before tax. After that you should pay tax, that is, sorry, before that we have working capital changes. What is the working capital changes means, let us see afterwards. Now after that step you have to pay income tax. Now you will get cash flow from operating activities after tax. After that you will arrive some extraordinary items, inflow or outflow. You should also do these adjustment. After this you will arrive cash flow from operating activities as per indirect method. So this is the format for indirect method. Now we are going through understanding the meaning of working capital changes. To understand these working capital changes, we have two presentations, that is gross presentation and element wise presentation. In gross presentation we compute opening working capital and closing working capital. After those it may increase or decrease in the working capital changes. That is, if there is an increase in working capital, it is taken an investment in working capital, that is outflow of cash from us, that is outflow of cash from entity. And likewise, when a decrease in working capital changes is taken as a release in working capital, that is inflow of cash, like debtors. While we are going through element wise presentation, in this method we need to analyze each and every item of current assets and current liability. In this way, when there is an increase in current liability, there is a outflow, so it is refers to the working capital changes. Likewise, when there is a decrease in the current asset, that is an inflow to the entity. And when there is a increase in current liability, there is also an inflow, because our current liability is going to increase, means there is an inflow of cash. Likewise, when there is a current liability is in decreasing, so it is an outflow of cash. So this is the treatment of working capital changes in CFS. So friends, there is a small note, that is items which form part of cash and cash equivalent will not form part of working capital changes, because once we have taken in the cash and cash equivalent, we should not bring the same to the working capital changes. For examples, cash balance we have taken in the cash and cash equivalent, bank balance also we have taken there, and the cash equivalents also we have taken there, OD balances also we have taken there, and cash credit balance we have also taken these also in cash and cash equivalent. So what are these is reflecting in the cash and cash equivalent, it does not reflect in the working capital changes. So this does not include in the working capital changes. Those are cash balance, bank balance, cash equivalent, OD balance and cash credit balance. So this is about CFS in IPCC level. So let us see some practical guidelines while preparing CFS. In the balance sheet you are seeing that there is an increase in the securities premium. So what is the meaning of it? Means there is a issue of share capital with a premium. It means the share value of your entity is 100 rupees and you are going to issue at 120. This 20 rupees is premium. So whatever shares you have going to issue that are issuing through premium, so there is a change in the increase in securities premium account. Likewise, when there is a decrease in the securities premium, means you are going to redeem your share capital with a premium. That means if the debentures are holding at face value of 100 rupees and you are going to redeem this at 120, so now your entity is going to redeem these debentures at a premium, so your securities premium account will decrease. Now let us see what is the tax treatment of provision for tax and tax paid. When here this is divided into two, that when opening provision and closing provision is given but tax paid is not given, in this situation what you will do? Opening provision is treated as paid and the closing provision is created as a current year provision. That is, whatever the opening provision you are thinking that is tax amount that is paid, and whatever the current provision is there, sorry, that is the closing provision, is treated as a current year provision. This is the treatment when the opening provision and closing provision is given, but the tax paid is not given. And when we come to this another side, that is when the opening and closing is given, in this again too, that if the provision created in the year is also given, so then what is the difference amount is taken as a paid. Likewise, if the paid amount information is given, so now here what is saying means, you have given opening provision, closing provision, and also they have given what amount of tax you paid. So the ultimate difference between these three, we will get the current year provision. Otherwise, you have given opening balance, closing balance, and what is the current year provision. So the difference what will come means, it is the tax paid. So this is the tax treatment of provision. Likewise, we have the tax treatment of dividend. Here dividend, when opening dividend and closing dividend is given but paid is not given, same. Likewise, tax treatment of provision. So in this situation, what you will do means, opening balance, that is you are taking as a paid, and the closing balance you are taking as a current year proposed dividend. Likewise, if the provision is created in the current year also, so here in this situation you have given opening balance, closing balance, and the current year provision also given. So after that, what you will arrive means, to opening balance you are adding to the current year provision. After that, you are going to deduct closing balance of proposed dividend. So what you will arrive means, whatever the proposed dividend you are paid. Likewise, when you are giving opening proposed dividend, closing proposed dividend, and also paid, now what is the difference? That is the current year proposed dividend. So this is the treatment of some of the aspects in CFS. So with this we have completed our CFS topic.